My name's Megan, and I'm the Vice President of Research at Likefolio. And the goal of this presentation is just to highlight how we are using social data to spot opportunities. Um, I think that social data has become extremely relevant just of late with all the buzz surrounding buzz. And just to clarify, that's not us, but it's a similar concept in the fact of we're trying to, harness the power of social media and what consumers are talking about to get ahead of the street. So just as a disclaimer, this is not investment advice, et cetera, et cetera. So we are primarily using Twitter to understand what consumers are talking about. And so this is the main premise of how we function and the edge that we try to provide investors. One thing that we do if you do want to connect with us, we have a daily newsletter that we put out for free, and you can go to likefolio.com/drop to sign up. We usually send out about 3 nuggets a day of just things that we're following, daily insights and things of that nature, but just wanted to go ahead and put that out there at the very beginning. So first, for some background about how we do what we do, we have a partnership with Twitter. So this means we have full access to the complete history of Twitter, meaning that whenever we're adding a company to our coverage, whenever we're listening for a consumer trend, we can track this data all the way back through 2012. One thing I will note is we're only listening to English-speaking tweets, so you can imagine that this somewhat limits our coverage universe in the sense that, we're going to focus in on companies that are more primarily focused in the US, or at least among English speakers. And we're also, more focused on these consumer facing companies. So consumers are much more likely to talk about their new Apple iPhone than they are, say, maybe even which gas station that they stopped at. If you want to check out more about our Twitter partnership, they actually did a case study about some of our success with Roku and Chewy in the last year. And you can go to the Twitter dev site if you want to read that case study. And so this is kind of now getting into the nitty gritty of how we do what we do. The first step is, we have to really understand all the different ways a consumer could be talking about a publicly traded company. This is an example of our brand map for Apple. Obviously, this isn't comprehensive, but just to give an idea that, if you simply were listening in for the hashtag Apple, that's not really how consumers talk. And that's also not comprehensive for the way that somebody could be talking about whether they're getting an Apple Watch, whether they're signing up for the new, Apple TV subscription service, whether they are getting a new iPhone. So it's important to understand all the different ways and all the different entry points that a consumer could potentially be making a transaction or sharing an experience with a company like Apple. These are a handful of the different brands that we track inside of Apple, just to give an idea of the breadth. You can imagine some of these companies, the Apples of the world, the Amazons of the world, they have a huge brand umbrella, and it's really important to be able to kind of slice and dice all these different segments, especially whenever you're trying to apply this to earnings or, just long-term growth for a company. We also try to think like the consumer would think. These are just a sample of some of the Apple Watch keywords that we have. And so a lot of times, we find that consumers don't speak on social media the way that they're supposed to speak on social media. A lot of times, they're using slang, they're using grammatically incorrect phrases. Somebody's tweeting about something, they don't care about where they place their comma or what they call something, but it's really important to know this. You can see, like, for example, the close my rings or close all 3 rings. That's somebody talking about using an Apple Watch. And so it's really helpful to kind of think like a consumer and not put yourself in a box so much. Another example I like to use is in Starbucks. If you can think of the different ways that you would spell, for example, one of their frappuccinos, if somebody's talking about going to get a new drink. We actually found that the misspelling of the Starbucks frappuccinos are more popular than the actual spellings. So in this case, sometimes it helps to think like a just regular human versus, spell check on Microsoft Word. To give breadth to our data, we are ingesting between 3 and 5 million tweets a day. At this point, our coverage universe is more than 350 companies. I would say the majority of these are going to be publicly traded. We do have some private companies in our coverage, and even I would say brand level data just to allow for comparisons. As you can see, a ton of brands, a ton of unique phrases that we're listening for. And these snapshots, this is something that's really interesting because one thing that we realized, I talked about we're getting data all the way back in time for consumers talking back to 2012. Well, let's say you're looking at a company like Amazon, for example, and you're getting that data all the way back to 2012. Well, Amazon owns Whole Foods now, but they didn't always own Whole Foods in that history. So we need to know when brands have changed ownerships, that way we can apply a start and a stop point on the different levels of brand data so we can better understand, okay, these are the actual purchases that should be attributed to Amazon at this point in time, or should be attributed to any company in our universe at this point in time. And we call these snapshots. So this allows us to create a really nice point in time chart of engagements with this company. And we've actually found that those snapshots are a valuable product in and of themselves. A lot of people, a lot of our clients just use the snapshots to kind of overlay on top of their own data sources. So now this is kind of what we're looking for. So the first step, as I mentioned, is we're looking for a mention of that publicly traded company. So somebody talk about an iPhone. In this example, we're going through Skechers, and we're going to listen for, aside from that brand mention, aside from that product mention, we're listening for three key things. Are there signs of negative or positive sentiment? You can see those kind of highlighted here on this example. So did the consumer have good things to say about this brand? Did a consumer have bad things to say about this brand? How does this sentiment kind of change over time? But most importantly, the first thing that we want to key in on is purchase intent. And so this is an indication that the consumer has just spent money or completed a transaction with this brand or plans to in the near future. And the reason that purchase intent is so valuable for us is because we have found this to be highly correlated to revenue. We do back test all of our companies to understand which of the metrics that we're following creates the best predictive feature or predictive signal. And in most cases, this is a purchase intent. This is an excerpt from a study that Georgetown University conducted that essentially found that not only was this metric predictive of upcoming sales, but it also captured the unexpected component of sales growth. So I think that this is something that's really powerful, that, this can help spot, big shifts or big opportunities, whether to the up or the downside, based on these major shifts in consumer behavior that we're witnessing in real time on social media. So all of the tweets that we're pulling in and scored, we're doing this as we pull them in, and then we update that daily. So, we have a daily feed and a daily update of all of these different metrics, and we can really track this over time. And that's what allows us to kind of compare and say, okay, a company is gaining steam with consumers, or a company is losing steam with consumers. And, whenever you consider all of the metrics together, it helps to paint a really interesting picture of consumer health. And it helps us to quantify performance, especially ahead of earnings and even long term. So we'll go through a quick kind of case study first. This is American Eagle. So this is something actually from yesterday. Well, they reported earnings. They reported earnings yesterday after the bell, but this is one that we really had our eye on, because this is something, American Eagle has been hurt, especially in COVID, especially with all of the, store closures. They have a significant mall exposure, which may or may not necessarily be the best thing for them. Definitely not based on our data and the trajectory of mall visits. But this was a company that I think it would be hard to say, definitely didn't benefit from COVID, right? Or at least not on the, the upper level of whenever you're looking at trying to spot these winners. But what's interesting is people are really paying attention to names like American Eagle now to understand how the consumer is feeling now that things are starting to open back up. And so this is a really fun one to watch. And so this is what we were looking at heading into earnings yesterday. we knew that I think in the first 9 months of 2020, 45% of American Eagle's top line revenue was generated from online sales. So we knew that this was going to be a critical driver, especially in the quarter that they were about to report. And what you can see on these lines, these are these digital purchase intent mentions for American Eagle and for Aerie. And you can see this huge bump during COVID. Obviously, people were forced to go online. Stores weren't open, or they definitely weren't going into the store if they didn't have to. And so you saw this huge shift. And especially here for Aerie, this is their athleisure brand or their leggings brand and things of that nature. And this was performing really, really well from them. You can start to see the gap kind of closing between American Eagle and Aerie. This is definitely reflected in American Eagle's own priorities in terms of, I think they announced that they're, closing down a lot of just regular American Eagle stores, but they're planning to open more Aerie stores. They're really focusing on that Aerie growth. I think they want to hit 2 billion in revenue for Aerie. And you can see that Aerie is outperforming American Eagle, at least from a growth perspective, 20 points higher when it comes to purchase intent. So going into earnings, we had a feeling, we knew that the digital showing was going to be strong. And based on our data, it looked like Aerie is outperforming American Eagles. Another interesting thing that we see brewing just in general across the retail space is new denim purchase intent mentions. And so this is kind of an interesting chart to look at and to consider. You can see it's typically pretty stable. There have been a couple of, it's pretty flat from 2019 all the way through 2021. And just in the beginning of this year, you start to see this huge uptick. So there are a couple of things going on whenever we look at mentions. We can see that people are, after spending a whole year in yoga pants, they're ready to, actually wear jeans, and they need new jeans, and B, this fashion is shifting. And that was the biggest thing that we kept seeing, is that people are saying that all of their jeans were out of style. There's been this huge shift from, the traditional, especially in women's denim, the skinny jean, to more looser fitting denim, to, more bootcut styles, flared styles. And if you are a company like American Eagle, who boasts themselves as the leader in jean, at least in a younger demographic, this is a really good spot to be in right now, because you are about to be able to catch a huge potential tailwind and customers who need new jeans, not even just because things are reopening and now they need to wear jeans again, but because the fashion has shifted. So now they have to buy new jeans I guess you don't have to, but you get the gist, especially in a younger generation. So this is something that specifically in the last month for American Eagle, we've seen new jean purchases rise about 11% year over year. Another leader that people may not consider is Levi. That is one that we're definitely watching long-term. Levi's really benefiting from this because they have a lot of the more vintage styles that these new buyers are looking for. But this is an example of a way to apply kind of a macro tailwind to a specific company, just to help inform that thesis. And so this is an example of that drop that I put out yesterday, or that I was talking about, that we put out daily. This was the one from yesterday. So we said, expect strong digital numbers. Aerie is outperforming, and new jeans stand to serve as a really powerful tailwind. And then today, I think American Eagle is trading up as much as 14% at the open. I think now it's tempered. It's up about 5% since yesterday, but that's a pretty powerful performance for a company that essentially was forced to go, mostly e-commerce in 2020, and especially when people weren't really going anywhere. So this is one that, especially as things open back up, especially as, people get back out there, they could really be stepping into some potential growth. These are some headlines just from yesterday and from their release, just confirming kind of what we're watching. I know I listened to the earnings call, and I was thrilled whenever their team was actually talking about this shifting, or this new fashion cycle that, people are now renewing, kind of updating their wardrobes. And so that's something that you could apply not just to American Eagle, but to other retailers in the space that, this is something that we'll have a close eye on into 2021. This year it's kind of like the opposite of last year. Last year we were looking at all of the like, okay, if things close down, who stands to benefit? This is now, okay, with things opening up, who stands to benefit? And American Eagle is definitely one of the top performers, but just an example of how we apply our data to events, even like earnings events yesterday. So now we'll go into, these are 5 names that we've got an eye on in 2021 that our data shows some really interesting patterns underway. So this is just the last watch list. So these are the names I brought last time. I think I spoke in November and kind of how they've performed. I think this was through yesterday's close. So obviously some changes today, but in general, not a bad report last time. So one of the names that we've got a really close eye on this year is Upwork. I don't know if you guys use Upwork or have used Upwork, but I know especially our team here at Likefolio, we use Upwork or have used Upwork for years. We have some freelancers that have been working with us all the way back to 2016. The 2 main freelance platforms in our universe that we cover are Upwork and Fiverr. I'll say Upwork is definitely one that is more of like longer term projects. This is, longer term relationships, this is, you're onboarding essentially remote workers from anywhere, versus Fiverr, which we also use, but we typically use for these one-off jobs. So you set, you have a set price versus a specific like hourly hours per week that you're getting from a freelancer that you're keeping on long-term. So this is the blue line that you're looking at. These are mentions of people talking about Upwork. And so you can see that, especially in 2020, as there were more and more remote workers, there was pretty explosive growth. And what's been interesting, or what we like to see, is that this continued. So a big question that people are trying to understand whenever they're thinking of, okay, was this just a huge growth in 2020 because it was an outlier, because people were forced into this behavior and now they're going to switch back. And when we see data like this, when we see this continued strength, so, continuing to grow 27% quarter over quarter, almost 100% year over year growth in terms of platform awareness and platform usage, this is really valuable. This tells us, as it approaches all-time highs, that this has some staying power. And I think that you can see, obviously, the stock has been pretty explosive as well, but this is definitely one that, we're watching for any pullbacks. I could dare say right now we're in a significant pullback for the company versus all-time highs. And we think that it has a really solid showing, at least from a consumer perspective. When you look at this, you can see the consumer happiness levels are over 85% positive. Just for scale, that's pretty unheard of. When you look at even Fiverr, I think Fiverr is around 77% positive. So the people who are not just using Upwork to hire freelancers, but even the freelancers themselves are really happy with the experience that they're having whenever they're using the product. And so whenever you see sentiment rising, up 3% year over year, alongside this rapid adoption, that's a really, really good sign, because sometimes companies have problems with scale. And so we'll talk about that on a couple of the other ones that we see, where we're not necessarily seeing this, this really high consumer happiness and this really high, positive experience alongside this rapid growth of a platform. One thing that's really helping is, in general, remote work is being more widely accepted. It's more permanent. So whenever we look at mentions of people working from home, obviously this huge shift in March, I think that that's pretty much a duh factor. Everybody knew that this was happening, but now we're seeing the levels maintain at a really high level versus last year. So this tells us that there's some staying power, and that this wasn't just a temporary shift, that this is more long-term. It's also interesting. I don't have a slide for this, but one of the top things whenever we looked at New Year's resolutions this year was people wanted to people are really focusing on being more productive. That was the number one resolution. It wasn't a diet. It wasn't an exercise trend. The two things that consumers are most focused on in 2021 are productivity and mental health, which I think is very reflective of the kind of environment that we just came out of in 2020. And Upwork is definitely one that whenever we look at those mentions, you see productivity cited a lot, in that, hiring on a freelancer to help with these tasks has made, workers more productive, or made companies more productive. And I think more and more companies are finding these remote work options to be acceptable. So these are hiring freelancers mentions. And again, you can see this really spiking at the onset of COVID. And now we're starting to kick back up into this year. Right now, pacing up 19% year over year. This is just in the last month. So this is something that we've got an eye on to, you want to be sure that all of these different things are in alignment, that, you have these trends that are kind of enabling these companies or powering these companies to succeed, or creating an environment where their service is in higher demand. And then to see the mentions for a specific company rise alongside this, those are really positive signs to see together. Just some business updates. The amount of services that they've enabled is crazy, 2.5 billion in service volume in 2020. So there are a lot of users and a lot of transactions going on this platform. You can see that the marketplace revenue is growing. One thing I thought that was really interesting is that younger workers specifically are more likely to prefer control and flexibility. And their CEO noted that more than half of Gen Z college grads freelance. So one thing Upwork boasts is the talent level of its freelancers. So a lot of their workers, they do have this, they do have a college degree, not that you necessarily have to have a college degree, but the idea is that this is a qualified workforce that can seamlessly fit into your company. And that this is something that is attracting talent, because these freelancers, these new kids coming out of school, they want control, and they want to be able to be flexible, and they want to be able to live where they want and still work for a really interesting company. And so I think that this is definitely, that's kind of why this is on our watch list, especially to 2021, is because we see staying power in this trend. And we see this as one of the, as some continuation. So the next one is Peloton. And so this one is interesting because Peloton obviously was one of the largest winners of 2020, as, as gym shut down, things like that. This was kind of a duh. Well, obviously Peloton is going to do really well. But here's what's really cool for us when we look at this is that, holy cow, okay, yeah. So this was the surge in Peloton usage in March of last year. Obviously explosive, but look at it now. They just had a holiday season that eclipsed levels of demand that they recorded at the onset of COVID. So this is pretty incredible to see all of these mentions of people talking about purchasing a Peloton, or purchasing, maybe that's their tread. That's pretty incredible growth to continue beyond just a huge adoption spark. Another really positive sign that we watch is we're listening for the app usage mentioned. So one thing that Peloton did, they've got two different types of app subscribers. So you can either be subscribed, they're connected fitness subscribers. So maybe you have a machine and you're subscribing in that sense that you're following along in the live classes and things of that nature. But they also have a standalone app. So even if you don't have a Peloton or you don't have one of their products, you can pay, I think it's $12.99 a month, and have access to yoga or an outdoor guided run or strength training. I know this is what my household uses. I do not have Peloton, but I will tell you that we probably use the Peloton app daily to lead some type of workout. So it's an interesting alternative form of recurring revenue. And it's also showing some staying power. So you see this huge adoption during COVID, and now you're seeing that continue up. It's a steepened curve, as you will, that growth is really, really taking off. So this is a really positive sign of retention, that even, after all of these users got on board, you're still seeing this usage. You're still seeing this continued strength, which people may not expect out of Peloton. This working out from home chart reminds me a lot of the working from home chart that I just showed, and the fact that we're seeing some staying power to it. We're actually seeing it, start to bump up a little bit even at the kickoff of the new year. So, this is something that, to see this level, this kind of, I call it a valley. This valley is higher than this valley significantly, about 100% higher. So this is a shift that consumers are holding on to, at least thus far. So you can see these are some of the trends that we track. So these are all different fitness related. And I had to highlight these because if you look at the top 4 fitness trends that we're tracking: working out from home, virtual trainers, spinning, and cycling for exercises. All of them are green. This is great news if you're Peloton. And then on the flip side, you've got new gym memberships, which, keep in mind, this is in the last 90 days. So that includes the New Year period, down 91% year over year. So people aren't going back to the gym yet. You can see people talking about attending a group fitness class is down 75% year over year. So that is, that's really significant. That's something to watch. And I had to show this because this is kind of like the opposite of the Peloton chart. These are mentions of people who are signing up for or going to a Planet Fitness. And this is a huge negative divergence. And you can see just how far these mentions have fallen. But it's really helpful whenever you have this data, because you can kind of track all of these trends alongside each other to see, okay, who's the top performing in the fitness space? What is a good opportunity in the fitness space? If I'm trying to pick out, is there a winner? Is there a loser? All of these things become pretty obvious. This is kind of cool because it plots, the NLS, you got Nautilus, you got Peloton, and you got Planet Fitness on this chart. And on your x-axis, you've got the growth of mention. So you can see the growth that Peloton has exhibited in the past 90 days is still really, really impressive. The size of the circle is the volume. So this is just the sheer number of mentions. So you can see that Peloton, is receiving more mentions than both of these names. And then you can see this sentiment where you have, Planet Fitness is down here closer to 50%, where you've got the happiest consumers with Peloton. So this quadrant is definitely the quadrant that you want to be in if you're trying to spot a winner. And so, Peloton, they're on their last report, they raised their guidance. They also announced the plans to acquire an equipment manufacturer. It's really interesting because the biggest cause of negative sentiment that we record in Peloton is not related to the actual product themselves. It's related to the fact that there are delays in shipment. So like people can't get their hands on the equipment fast enough. So, and it's kind of, I would say, for a cause of negative sentiment, that would be the one that you want as a company versus a bad product. But a lot of people hope that this acquisition will help kind of ease the supply demand pressures that they're feeling right now. But they also indicated that their subscribers are sticking around, which our data certainly supports. So this is one to watch. If this gets dinged because it was a quote unquote COVID winner, it would be one that I would say, okay, not so fast. Yes, it was a COVID winner, but it's still performing really, really well, and still a winner in its space. The next one that we'll hit on is Affirm. And so this is a company that specializes in the buy now, pay later. So this kind of allows you to finance just regular purchases. So like, let's say you're on a website, let's say you're trying to order a Peloton, for example, and you want to split that into like 4 monthly payments, you can check out with Affirm, and Affirm will allow you to do this. And the mentions of this, you can see are really starting to take off into 2021. And so this is a relatively new IPO. So this is one where, you know, you would expect a lot of volatility. So that's why this is one that we're watching into this year, but we're really watching it. We're really excited about it because we're seeing this, a lot of buzz and a lot of interesting developments in this buy now, pay later space. So these are some of the brands that, or some of the merchants that are partners with Affirm. One thing I will note is that for companies like this, these merchant partnerships are critical because, you know, as a consumer, you're kind of limited to, you know, if you want to finance something, whoever that preferred partner is. Like I know, for example, for Crocs, the partner is Afterpay, which is another buy now, pay later service that we're tracking. I use Crocs because I know that Andy's obsessed with Crocs, and so I like to dig on him. But all of these partners are great partners to have, especially, you know, Peloton, I think, helped drive revenue significantly for Affirm in the last quarter. Also, these home furnishings and this home improvement boom that we've watched just in the last couple of quarters, that's really helped to drive Affirm's success. So this merchant partnership arena is one area to pay really close attention to. In general, you can see this is a chart of people who are talking about using a buy now, pay later service. A nice uptrend. It's starting to flatten out a little bit. And so that's something that we'll definitely keep an eye on. You know, you want to see this growth, but definitely that adoption and that usage rate is still really high. So on their last report, I think they got dinged. Shares are down pretty significantly. I think one big cause of this is that they noted in the last quarter that they financed 2.1 billion in gross merchandise volume, and that is expected to decline on a quarter over quarter basis. And so I think that they kind of, you know, investors punish them for this, but in a sense, you know, the amount of e-commerce transactions versus in-store transactions that happened, especially over the last year, that's a really hard growth rate to maintain. But that's definitely something to be aware of, something that we've got our eye on, just because, you know, you want to be able to see continued growth. Another interesting development that Affirm recently announced, I think last week, is they're calling it the anti-credit card. And the thought is that right now, as I talked about, they're so tied into these merchant partnerships. But the thought is if you have a card, you could theoretically use this card to help finance any kind of purchase that you would want. This is different from a credit card in the fact that there's no interest rates, but and you have these prescribed periods, these prescribed pay chunks, and it's hooked directly into your bank account essentially. But this will be one that we're listening for. Again, they only announced it a week ago, so kind of we'll see, but it is an interesting application or a way of kind of taking this one step further to enable consumers to continue to use this buy now, pay later service. Another interesting, just macro trend that we're tracking in general are credit card opening mentions. And you can see that those are kind of trending down. So in general, consumers are just more aware of their fiscal state right now, I think. And so this is kind of in line with, this is, I think, why Affirm is branding it as the anti-credit card, because, you know, they don't want it to be seen in that same lens, although it is allowing you both accomplish the same goal, right? You're still buying now and paying later, but a different branding, if you will, a slightly different application. Another interesting something that we're watching really closely is their partnership with Shopify. So Shopify has an 8% stake in Affirm in due to their integration into Shop Pay. And so this is I don't know if you've ever bought something, for example, whenever I shop, if I'm buying something off Instagram or off Facebook, I can check out with Shopify Pay. It has all my info. It's super easy and I can get in, get out. And that their partner, preferred partner is Affirm. Right now, they're in beta with more than 100 different Shopify merchants. And so this is a potential growth driver for them moving forward. These are our mentions of Shopify, just to show you why that partner is so important for someone like Affirm. You can see these are pretty explosive. And then these are those Shop Pay mentions. So these are mentions of people actually checking out with Shopify Pay. That's a pretty nice growth clip that you're watching. So this has the potential to help drive sales with Affirm, and it's definitely something that we'll be watching moving forward. But this is a really new IPO, so definitely expect volatility. But right now, the data is shaping up nicely from a consumer demand perspective and consumer usage perspective. All right, now we got Fubo. So Fubo, I think Fubo is most known because of how it enables live sports, but this is just an example. So for me, there are over 200 channels that I could watch. The thing about Fubo is it's not traditional cable. So you don't have a box. This isn't like a dish set. This is all streaming. This is all over the top, which, so you've seen, this is another, Hulu or Netflix or streaming provider, but it's live TV. So I think that the two closest competitors to Fubo, are YouTube Live and Hulu Live. These are mentions of Fubo TV. And so you can see these, I talked about how important sports was. You can see this kind of dip in here when there were no live sports, that was really tough to garner, get people to pay for this live service. But now it is nearly vertical. We're pushing through all-time highs. Mentions of the platform are up 100% year over year. So we've got a really close eye on this. These are mentions of people actually signing up for the service. So this is, that purchase intent, like I was talking about, also pushing all-time highs. You like to look at the mentions and the purchase intent, because a lot of times, purchase intent is great because it shows that initial sign on, that initial, okay, yes, I'm now part of your service. But mentions is going to capture those usage mentions too. So, once you're already on it, like if you're just talking about your experience with the service because you're using it. So this can be a good metric or a good thing to look at when you're trying to understand retention. Another really interesting thing that we're watching is that Fubo's sentiment is improving. It's up about 7% year over year. And we're seeing a lot of this, I'm switching, either I'm cutting cable or I'm switching even streaming providers. And a lot of people are recommending Fubo or talking about switching to Fubo. And so that's when you start to see those mentions bubble up alongside that sign up mentions and just generic mentions, buzz about the product. That's really important. In general, too, I don't think that cutting the cord, I don't think that that's like a novel theme anymore. Most people have some type of streaming service that they're using, but you can see this continue to accelerate. So people who are talking about streaming this media content, currently pacing up 71% year over year. So this is something that's serving as a tailwind for Fubo. We definitely like that their sentiment is shaping up, that we're starting to see a lot of kind of switching into Fubo mentions. They got crushed though yesterday. They released their earnings, and I think that there was a lot of coincidentally that when they released earnings, Dish also announced a partnership with DraftKings. And so Dish Network and Sling TV, that what they're doing is they're integrating DraftKings into the platform so that you can place these bets on live sporting events while you're watching it, which is really cool. It's very cool. And that's something that Fubo has said that they want to do. And so I think that a lot of investors were speculating about this and what that meant for the future of Fubo with this, growing competition in this space. I will say that in our data overall, the Dish purchase intent mentions of people who are having Dish or signing up for Dish, those are falling year over year. So it doesn't surprise me that Dish is trying to figure out how to get people to stick around. It remains to be seen if that is actually going to move the needle in Fubo. We'll definitely be watching, but thus far, that's a really, really new development announcement. This is one of their edge is in sports. And I think what's interesting is that Fubo has been growing their advertising revenue, because what they found is that this live sports edge, there's the reason that they're partially why they're prioritizing it, is because it attracts what advertisers to consider a premium audience. And so that's ideally, if you are an over-the-top streamer like Fubo or even like a Roku, you want to attract that premium audience. So you want to attract those advertisers to reach that audience. Another interesting thing that they announced, this is from their earnings call yesterday, is that they completed the acquisition of this interactive gaming company. So this is something that we'll be watching closely. This is kind of that sportsbook integration. So instead of going the route that DraftKings or that Dish went to pull in DraftKings, Fubo is starting their own sportsbook inside of their program. So we'll definitely be tracking this as it unfolds. But so far, consumer demand for the platform is growing. Consumer demand for live sports is growing. Consumer demand to be able to stream live sports versus go with a traditional cable provider is growing. So all of these are serving as nice catalysts for Fubo, and that's definitely one that we've got an eye on. And right now, with the recent fall in the market, it could be a nice entry if you believe in this long term. Definitely something we got an eye on. The last one is Vroom. Vroom reminds me of Fubo too, in the sense that it has been just hammered of late, the last couple of days. But here's the reason I brought it to you. So these are our, this is, a way that we use to sort through different watch lists of different names that are popping. And so what this is the percent growth, so the percent change in the 90-day moving average year over year for all of the companies in our coverage universe. And you can see that Vroom is 1 or 2 in mentions and purchase intent growth. So this is a company that consumers are rapidly discovering and rapidly, being turned on to, and they're starting to use the platform. It's rapid adoption period right now. You can see these mentions. This is kind of, that level of growth is pretty crazy. So you've got a lot of people who are starting to talk about Vroom specifically. I will say in this, you'll notice the sample size, don't get alarmed because it seems small, because consider the nature of what we're doing, in the sense that imagine this company is called Vroom. So imagine all the different ways a consumer could be saying the word Vroom, and they're definitely not talking about the company. So we take that into consideration. So we have really targeted algos for this one to make sure that we're only pulling in those true mentions. And whenever, we found when we compare this over time, this is much more predictive of revenue than obviously false hits. But that's kind of some background as to why Vroom has a little bit of a smaller sample size. It's just because we're being really selective, and we want to make sure we isolate only those mentions of people who are actually talking about the online car buying company. You can imagine something like a Carvana. That's a lot easier to pick out, because I don't know many people who would use the word Carvana and not be talking about the online car sales company. So this is mentions of people who are talking about buying a car online. And you can see there it's pacing up about 20% year over year. And I included these related companies just so you can see that Vroom, while it's a smaller sample size, so let's be clear about that, its growth is exponential right now. So if we'd be crazy not to at least have this on our radar to be watching. Just to be fair, this is the sample size for Carvana. So the two main, online car sellers in our universe that we're tracking are Vroom and Carvana. And you can see Carvana is also experiencing, a large adoption rate, a large increased usage and mentions of people talking about the platform. Not quite as rapid growth as the Vroom, but it is still really high. So these are some macro drivers. Aside from that digital online car buying, you can see that, there's a preference, or we're starting to see a shift for a preference of used cars. We're also seeing this new generation start to trickle into this, car buying. You're looking at millennials are leading car ownership growth, and comprise almost half of the people who plan to buy a car in the next 6 months. So you've also got a preference of this younger demographic to conduct things, or they're interested in this contactless service. So I think that one of the biggest limiters for Vroom right now is its sentiment. And so this is something that I think was pretty clear on its conference call, is just that its execution on its last report. It's not that sales weren't increasing. It was more of a matter of the company couldn't effectively meet consumer demand. And we're definitely seeing this reflected in our sentiment metric. So this is really promising for me, because this is something where if I want to track this long term, and when I start to see really significant improvements in this sentiment, I'm going to know that Vroom has finally gotten its stuff together, right? These are some of the mentions that we're looking at. And it's interesting because this means, if people love to complain on Twitter. So if people are going online to talk about a bad experience that they had with the company, they're trying to engage with the company. They're at least trying to interact. They're trying to complete a purchase. So the demand is there. And I think that that's evident in the purchase intent mentions that we're looking at, and the overall mentions that we're looking at. But Vroom definitely has steps to improve its experience and its actual delivery. And so you can see the shares are down today, but on the upside, they're moving more cars. So this is one where, again, I think that they have tremendous growth potential, but they need to kind of get their house in order in terms of the consumer experience. So that's where that sentiment metric is going to be really, really important to watch. If this is something, though, where maybe you're considering Vroom, maybe this is one that you've had your eye on and you're wondering, like, is the data there? Is the demand there? Yes, it's the demand is absolutely there. But consumers are absolutely, checking out Vroom. It's more of a matter of execution. And so that's something that something we'll be watching moving forward. And so just to end, these are the 5 names that we chatted about today that'll be on our watch list in 2020. If you wanted to sign up for the daily drop, this is likefolio.drop. You can check that out, but let me see. I can try to take some questions now if I can see this chat. So, so I'm just looking through these. I'd love your opinion of Buzz, which started trading today. It's an interesting, that's an interesting one to watch. It's definitely one we're tracking. We sent out a note yesterday, I guess, listening to the mentions of the hashtag Buzz. And so it's interesting that we are also able to kind of look at those hashtag mentions. I think you'll see in the presentation, though, what we're doing is a little bit different in that sense, in that we're trying to look at what consumers are talking about buying organically versus what investors are trading. But we do have somewhat of a an investment trading product, that's just not the one that I featured today. So it's definitely going to be interesting to see how that unfolds and to see how that performs in the long term. And then does anybody else have questions? All right. Well, thank you guys so much. Yeah, feel free to, if you have questions, my email is megan@likefolio.com. So feel free to reach out. This has been great though.